The Modigliani-Miller M&M Theorem. A comprehensive overview. The Modigliani-Miller M&M Theorem, developed by Franco Modigliani and Merton Miller in the 1950s, is a foundational theory in corporate finance. It elucidates the relationship between a firm's capital structure, the mix of debt and equity financing, and its overall value. The theorem is predicated on a set of idealized assumptions and comprises two primary propositions. Core tenet. The central premise of the M&M theorem is that, under specific idealized conditions, a firm's market value is independent of its capital structure. In simpler terms, how a company finances its operations, whether through debt, equity, or a combination thereof, does not affect its total value. Underlying assumptions. The M&M theorem is built upon the following simplifying assumptions, which create a theoretical perfect market environment. 1. Perfect capital markets. Absence of taxes, transaction costs, and bankruptcy costs. Universal access to information. 2. No taxes, no corporate or personal income taxes. 3. No bankruptcy costs. No costs associated with financial distress or bankruptcy. 4. Equal borrowing rates. Firms and individuals can borrow at the same interest rate. 5. No agency costs. Managers act solely in the best interests of shareholders. 6. Fixed investment policy. The firm's operational and investment decisions are independent of its financing decisions. M&M, Proposition I, Capital Structure Irrelevance. Statement. In a perfect market, a firm's value is unaffected by its capital structure. Intuition. The firm's value is determined by its assets and operating cash flows, not by how those assets are financed. The pie, firm value, remains the same size regardless of how it's sliced. Debt versus equity. Example, two identical firms, A, all equity, and B, 50% debt, 50% equity, will have equal total values under Proposition I, as their underlying cash flows are the same. M&M. Proposition 2. Cost of equity and leverage. Statement. The cost of equity for a leveraged firm increases linearly with its debt-to-equity ratio, while the weighted average cost of capital (WACC) remains constant. Intuition. Increased debt raises the risk for equity holders, leading to a higher required return. However, the WACC remains unchanged as the lower cost of debt offsets the higher cost of equity. Formula. R_E equals R_0 plus DE. Asterisk, R_0 minus R_D, where R_E equals cost of equity for a leveraged firm. R_0 equals cost of equity for an unlevered firm. D equals market value of debt. E equals market value of equity. R_D equals cost of debt. Example. An unlevered firm with a 10% cost of equity, upon taking on debt at 5%, will see its cost of equity rise as its debt-to-equity ratio increases, but its WACC will remain constant. Real-world considerations. Relaxing assumptions. In reality, the M&M assumptions do not hold. This leads to deviations from the theorem's predictions. 1. Taxes. Interest tax deductibility creates a tax shield, favoring debt and increasing firm value. Formula. VL equals VU plus T_C asterisk D, where VL equals value of a levered firm, VU equals value of an unlevered firm, TC equals corporate tax rate, D equals market value of debt. 2. Bankruptcy costs. High debt levels increase bankruptcy risk, incurring costs that reduce firm value. This is the basis of the trade-off theory. 3. Agency costs. Conflicts between managers, shareholders, and debt holders influence financing decisions. 4. Information asymmetry. Managers' superior information can affect financing choices, creating signaling effects. Practical illustration. Firm X, all equity, value $1 million, and Firm Y, 50% debt, 50% equity, have equal values. $1 million in a perfect market. With a 30% corporate tax rate, firm-wise tax shield, $150,000 from $500,000 debt, increases its value to $1,150,000. Excessive debt, however, could lead to bankruptcy costs, reducing firm-wise value. Conclusion. The M&M theorem provides a theoretical benchmark for understanding capital structure. While its assumptions are idealized, it highlights the importance of market efficiency and the impact of real-world factors. The theorem serves as a foundation for analyzing how taxes, bankruptcy costs, and agency problems influence a firm's value and financing choices.